The Nasdaq had just peaked at 5,048 points. 30 months later, it had lost 78% of its value. $5 trillion gone. September 2008. Lehman Brothers collapsed. The S&P 500 would fall 57% from its peak. $16 trillion in household wealth evaporated. Today, the S&P 500 sits near all-time highs. Magnificent 7 stocks have carried the entire market. Retail investors are flooding back in. And every single warning sign from those previous crashes, they're flashing red again. This isn't about predicting the future. It's about recognizing a pattern that has repeated itself for centuries. And right now, in 2025, that pattern is completing itself once more. To understand where we are, you need to understand where we've been. Because market crashes don't happen randomly. They follow a script. And that script is playing out right now. The roaring 20s, the dot-com bubble, the housing boom. 3 different eras, 3 different generations. But the exact same psychological pattern. It starts with innovation. Something genuinely new enters the economy. In the 1920s, it was electrification and automobiles. In the 1990s, the internet. In the 2000s, financial engineering and subprime mortgages. Today, it's artificial intelligence and the magnificent 7 tech stocks. Here's what happens every single time. People stop calling it a bubble. They call it a new paradigm. They say, this time is different. In 1929, economist Irving Fisher declared that stocks had reached a permanently high plateau. 9 days later, the market crashed. In 1999, analysts justified sky-high valuations by inventing new metrics, price to eyeballs instead of price to earnings. Traditional valuation methods were dismissed as obsolete. In 2007, banks convinced themselves they'd eliminated risk through diversification. They created models that said a nationwide housing price decline was statistically impossible. Today, the narrative is that AI will transform everything, that these 7 companies are too important to fail. That concentration risk doesn't matter when the companies are quality. The innovation was real each time. Electricity did transform the world. The internet did change everything. Housing was a real asset class, and AI will genuinely reshape the economy. But that's not what causes the crash. The crash comes from what humans always do with genuine innovation. They over-extrapolate. They over-leverage. They ignore every warning sign. And the warning signs? They're here. Right now. Let me show you. Let's start with how we got here. March 2020. The pandemic crashes the market. The Federal Reserve responds with the most aggressive monetary intervention in history. The Fed's balance sheet explodes from $4.2 trillion to $9 trillion in 18 months. Interest rates drop to 0. The government floods the economy with stimulus checks, PPP loans, and direct payments. Suddenly, everyone's a trader. Robinhood adds millions of accounts. Reddit's Wall Street Bets explodes. People with stimulus checks and nothing to do start buying stocks, options, cryptocurrencies. GameStop becomes a battleground. Dogecoin, a literal joke cryptocurrency, hits a $90 billion market cap. This is phase 1 of every bubble. Free money creates the illusion of genius. When everything goes up, everyone thinks they're Warren Buffett. But here's what most people missed. This wasn't sustainable economic growth. This was monetary inflation disguised as wealth creation. By 2023, something unprecedented starts happening. 7 companies, Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla, begin to dominate the entire market. The Magnificent 7 becomes the story. In 2023, these 7 stocks account for nearly all of the S&P 500's gains. Remove them, and the market is basically flat. Look at this chart. The blue line is the regular S&P 500 weighted by market cap, dominated by those 7 giants. The red line is the equal weight S&P 500, where every company counts the same. See the divergence? That's concentration risk. We've seen this before. In the early 1970s, investors piled into the Nifty 50 blue-chip stocks that supposedly you could buy and never sell. Companies like Polaroid, Xerox, Kodak. They had price-to-earnings ratios of 70, 80, even 90. Then 1973 hit. The Nifty 50 collapsed. Polaroid fell 91%. Xerox dropped 71%. It took decades for investors to recover. Today, Nvidia trades at similar valuations to those Nifty 50 stocks. Tesla's pay ratio has touched 60, 70, sometimes higher. The justification? AI will change everything. Just like the internet would change everything. Just like electrification would change everything. It did change everything, but that didn't stop the crash. By late 2024, the warning signs are everywhere, but markets keep climbing. This is phase 3 of the pattern, when warnings are dismissed as negativity or not understanding the new paradigm. The Buffett indicator total, stock market capitalization divided by GDP, reaches 195%. The only other times it's been this high? 1,929, 2000, and 2021. All preceded massive crashes. Margin debt money borrowed to buy stocks hits near record levels. When investors borrow money to buy stocks, they're making a leveraged bet. If the market drops, they're forced to sell, which pushes prices down further, which forces more selling. It's a death spiral. Corporate debt reaches $48 trillion. Companies have spent years borrowing cheap money to buy back their own stock, artificially inflating share prices. But now, interest rates are higher. Debt that was cheap to service at 2% becomes crushing at 5%. But here's what the mainstream financial media is saying. The economy is strong. Unemployment is low. Corporate earnings are solid. This is a new bull market, not a bubble. Let me show you something. 2007 CNBC. The housing market is strong. There's no bubble. 1999 CNBC. The internet changes everything. Traditional valuations don't apply. 1929 newspaper. Stock prices have reached a permanently high plateau. It's the same script every single time. Throughout 2024, something subtle but critical happens. The AI narrative begins to show cracks. Multiple AI startups fail to deliver on promises. The cost of training AI models explodes. Questions emerge. Is this actually going to generate trillions in profits? Or is this another technology that's real, but wildly overvalued? Nvidia, the poster child of the AI boom, starts experiencing wild volatility. Up 10% one week, down 8% the next. This is a $3 trillion company. When companies this large become this volatile, it's a symptom of uncertainty masquerading as confidence. And here's the critical data point. By late 2024, corporate insiders, the CEOs, CFOs, board members are selling stock at rates not seen since 2021. They're selling at the top. They know something. The ratio of insider selling to buying reaches 10-1. For every dollar of stock corporate insiders are buying, they're selling $10. These are the people who know their companies best, and they're running for the exits. Meanwhile, retail investors, everyday people, are pouring money in. Robinhood account openings surge. Fidelity reports record IRA contributions flowing into index funds. This is the point of no return. Not because a crash is guaranteed, but because the psychology has locked in. The smart money is selling to the hopeful money. The concentration is extreme. The valuations are extended. The leverage is high. All you need now is a catalyst. And in markets this fragile, anything can be a catalyst. Now let me show you how crashes actually happen, because it's never the thing that is imagined. In 1929, the catalyst wasn't economic, it was psychological. After a summer of speculation, a few large investors started selling in October. Others noticed. Selling begat selling. October 28th, the market dropped 13%. The next day, Black Tuesday, it dropped another 12%. Panic had set in. In 2000, the catalyst was the Microsoft antitrust ruling and rising interest rates. But the real problem was that internet companies were burning cash with no path to profitability. When investors finally asked, wait, how will these companies ever make money? It was too late. The Nasdaq lost 78% over 30 months. In 2008, the catalyst was subprime mortgage defaults. But the real problem was leverage. Banks had borrowed $30 for every $1 of capital. When housing prices stopped rising, the entire system seized. Bear Stearns collapsed in March. Lehman Brothers collapsed in September. Within weeks, the global financial system was on the brink. Today, the catalyst could be anything. An unexpected recession, a geopolitical shock, a major tech company missing earnings, a sudden disappointment, something we haven't even considered. But here's what matters. The catalyst doesn't cause the crash. The catalyst reveals the fragility that was already there. Phase 1. The first crack appears. Maybe it's NVIDIA missing earnings guidance. Maybe it's a major AI company shutting down. Maybe it's a recession indicator triggering. The market drops 3 to 4%. Everyone calls it healthy consolidation. Phase 2. The drop continues. The S&P 500 falls 10% from its peak. Now it's officially a correction. Financial media remains calm. Corrections are normal. This is a buying opportunity. Phase 3. The algorithms take over. High-frequency trading systems detect the trend. They begin selling. This pushes prices down further. More algorithms trigger. Stop losses automatic sell. Orders start executing. The selling feeds on itself. Phase 4. Margin calls begin. Remember all that borrowed money used to buy stocks? Now those loans are being called in. Investors are forced to sell to meet margin requirements. This selling pushes prices down more, which triggers more margin calls. The death spiral has begun. Phase 5. The Magnificent Seven start falling in unison. When these 7 stocks, which make up 30% of the S&P 500's value, all fall together, the index collapses. A 20% drop in the Mag 7 means a 6% drop in the entire S&P 500, even if every other stock stays flat. Phase 6. Panic selling. Retail investors, watching their retirement accounts crater, sell everything. The volume overwhelms the system. Circuit breakers' automatic market pauses trigger. This creates more panic. If they're stopping trading, it must be really bad. Let me make this concrete, because numbers are abstract. Let's talk about real impact. The median American has about 65% of their net worth in their home and retirement accounts. When the stock market falls 40%, retirement accounts fall 40%. A 401k with $300,000 becomes $180,000. That's $120,000 of retirement security gone. Home values follow. In 2008, home prices fell 33% nationally, more in some areas. Homeowners who bought at the peak found themselves underwater owing more than their house was worth. They couldn't sell. They couldn't refinance. Many walked away. Then come the layoffs. Companies that borrowed heavily to finance operations can't refinance in a crisis. They cut costs. That means people? In 2008, unemployment rose from 5% to 10%. That's 7.5 million people losing their jobs. Retirement gets delayed. In 2008, the average retirement age jumped from 63 to 66 as people watched their savings evaporate. People who had planned to retire in their early 60s found themselves working into their late 60s or early 70s, hoping to rebuild what was lost. The wealth destruction is generational. Millennials who entered the job market during the 2008 crisis still earn less than they would have otherwise. Gen X lost prime earning years. Boomers saw retirement plans destroyed. And here's the cruelest part. The recovery is not evenly distributed. Large institutions, hedge funds, and the wealthy buy assets at the bottom. They have cash reserves. They can wait. The average person, forced to sell to meet bills, locks in losses at the worst possible time. After every major crash, wealth inequality increases. The 2008 crisis accelerated wealth concentration. The COVID crash did the same. The next one will too. This is the pattern. Innovation creates genuine opportunity. Speculation creates a bubble. Psychology creates a crash. And ordinary people bear the cost. So what happens after a crash? And what can we learn from every previous collapse? Within days of every major crash, governments respond. In 1929, the response was inadequate, which turned a crash into the Great Depression. They'd learned nothing from previous panics. By 2008, they'd learned maybe too well. The Federal Reserve slashed interest rates to zero. The government passed $700 billion in bank bailouts. Quantitative easing began. The Treasury guaranteed money market funds. It worked, kind of. The market bottomed in March 2009, but the recovery took years. The S&P 500 didn't reach its 2007 peak again until 2013. 6 years of zero returns. And that's if you held on. Most people didn't. Studies show retail investors sold at the bottom and missed the recovery. They locked in permanent losses while institutions bought cheap assets. Here's what mainstream analysis misses. The costs of a crash extend far beyond the immediate market loss. Trust evaporates. After 2008, an entire generation became skeptical of Wall Street, banks, and investing. Millennials kept their money in cash for years, missing the entire recovery. That conservatism cost them hundreds of thousands in lost returns. Policy distortion occurs. To prevent collapse, central banks implement emergency measures. Those emergency measures become permanent. Zero interest rates that were supposed to last months lasted a decade. Quantitative easing that was meant to be temporary expanded to trillions. These distortions have consequences. Pension funds, which need 7% returns to stay solvent, can't achieve them at zero interest rates. They take more risk. When the next crash comes, pensions collapse, forcing retirees into poverty. The social fabric tears. Economic hardship correlates with political extremism. The 2008 crash arguably led to both the Tea Party and Occupy Wall Street, populism on both sides. Crashes don't just destroy wealth, they destabilize society. Every financial crisis in history follows the same arc. Phase 1. Innovation. Something genuinely new creates opportunity. Phase 2. Speculation. Easy money and human psychology turn opportunity into excess. Phase 3. Mania. Rational analysis is abandoned. This time is different. Phase 4. Warning signs. Insiders sell. Valuations stretch. Leverage builds. Warnings are ignored. Phase 5. The catalyst. Something breaks. Often something small. Phase 6. The cascade. Selling feeds on itself. Leverage unwinds. Panic spreads. Phase 7. The collapse. Wealth evaporates. Confidence disappears. The cycle completes. The South Sea bubble of 1720. The panic of 1907. The 1929 crash. The 1987 Black Monday. The 2000 dot-com bust. The 2008 financial crisis. The 2022 crypto collapse. Different assets. Different eras. Identical pattern. Understanding this pattern doesn't let you time the market perfectly. Nobody can do that. But it does let you recognize when conditions are dangerous. And here's the critical insight that most people miss. The crash is not a failure of the market. It's a feature of the market. Markets exist to price assets. When assets become dramatically overpriced, the market corrects violently. Warren Buffett has said, "The stock market is a device for transferring money from the impatient to the patient." He's wrong. It's a device for transferring money from the late to the early, from the over-leveraged to the under-leveraged, from the hopeful to the prepared. Every crash is preceded by a period where caution is mocked. You're missing out. Don't fight the Fed. Stocks only go up. The people saying this have convinced themselves. They're not lying. They genuinely believe it. Until they don't. And by then, it's too late. So let's talk about today, 2026. I'm not going to tell you a crash is coming tomorrow. Nobody knows that. What I am going to tell you is that every warning sign from previous crashes is present right now. The Magnificent Seven represent 30% of the S&P 500's value. The last time a handful of stocks dominated this much? The Nifty 50 in 1972. That ended with a decade of stagnant returns. When the market is this concentrated, diversification becomes an illusion. You think you're diversified across an index fund? You're actually betting on 7 companies. If they stumble, everything stumbles. Every single valuation metric, price to earnings, price to sales, market cap to GDP, is flashing red. These metrics aren't perfect. They can stay elevated for years. But eventually, they revert. They always revert. The argument today is AI justifies these valuations. Maybe. But the argument in 1999 was the internet justifies these valuations. It did change everything. But Amazon still fell 93% from its peak before recovering. Retail participation is surging again. Options trading, particularly speculative call options, is at record levels. This is a sign of late cycle speculation. Professionals are selling. Amateurs are buying. The language has shifted too. People don't talk about investing in companies. They talk about catching the momentum and riding the wave. When the focus shifts from fundamentals to price action, you're in the mania phase. Look at this. Here's the dot-com bubble pattern from 1998 to 2000. Steady rise, acceleration, concentration in tech, mania, collapse. Here's the 2008 pattern. Steady rise, acceleration, concentration in financials and housing, mania, collapse. And here's today. Steady rise since 2020, acceleration in 2023 to 2024, concentration in the Magnificent Seven, AI mania. The pattern isn't complete yet, but every element that preceded previous crashes is present. Does that mean a crash is inevitable? No. Patterns can break. Maybe AI really does justify everything. Maybe this time genuinely is different. But 400 years of financial history suggests betting on this time is different is the most expensive bet you can make. The railroads will transform everything. 1870s, before the panic of 1873. Electrification creates limitless growth. 1920s, before 1929. The internet changes all valuation models. 1990s, before 2000. Housing prices never fall nationally. 2000s, before 2008. Hey, I will transform everything. Today, all of these statements were true, and all of them preceded crashes. Here's the truth. Markets crash. They always have. They always will. It's not a failure, it's a feature. It's how prices discover reality. The question isn't, will there be another crash? The question is, are you positioned to survive it? Understanding history doesn't give you a crystal ball, but it gives you perspective. It shows you that the euphoria you're feeling right now is the same euphoria that's preceded every crash. That the dismissal of warnings you're hearing is the same dismissal that's always happened. That the "this time is different" narrative is the oldest story in finance. What do you think? Are we in a bubble? Are these warning signs real or just noise? Drop your thoughts in the comments below. I read every single one. And if you want to understand what comes after a crash, watch my next video on the 2008 recovery and why most people missed it.